Hello and good morning, listeners. Welcome back to Almus Market Mornings with Shikhar Garg, your digital space for global financial update. And with updates, I must say there's been quite a mix of data released yesterday for the domestic markets, with the inflation falling back in the RBI's permissible band at 5.88% against the expected 6.4%. But the industrial production data didn't quite show any strength, as it was minus 4% against a positive 0.3%. Likewise, there's also some data releases for the US markets today, majorly on the inflation front, and it seems that the investors across do not have much of a fear for a hotter inflation data to be released today. Rather, they are expecting it to be in line with the way of softer expectations. So, JK, I'd like to know whether these CPI numbers would justify Fed's decision to reduce the pace of hike, or what should we be expecting out of this?
Good morning. Let's start with the Indian macro numbers. The good part was no doubt CPI coming at 5.88 from 6.77, well below market expectations. Falling below 6% for the first time after 10 months, which is the RBI's target. Our core inflation remains sticky above 6%, and food inflation deceleration has been the main driver of this moderation in headline CPI, although base effect has also helped. There is an expectation that this could put more downward pressure on the CPI in the coming month as well, as moderating global food prices and bountiful winter harvest at home play out. As for the policy implication, I think sticky core inflation will keep alive expectations for another 0.25% hike in February. But any cheers after the CPI numbers were dampened by the uninspiring industrial production number, which came at minus 4%. Mixed factors for this underperformance, like anemic performance of exports, and temporary factors like festival holiday period. Although the manufacturing sector continues to show very low performance, and that was a big drag. So monetary policy, of course, is unlikely to take a great influence from this IIP number, which anyway remains quite a volatile series. Rupees underperformance is well entrenched, struggles to even revert to 80 to 20 despite lower oil, weak DXY, and rally in domestic stocks. And with no resistance from RBI to the one-way rally seen from 81.15 to 82.75, leading players to infer a tacit support for a weak currency. One fallout of the weaker CPI number yesterday is that the pressure to keep currency strong to address higher imported inflation is now reduced. On the global markets, data slate was quite low, and the UK economy, of course, showed good output numbers, growing at 0.5 versus minus 0.6 in September, and manufacturing sector, and as well as the trade numbers putting up a good number. But these are not, taking away the expectations of deep slump in the UK economy, unless we see a significant turnaround in policy making or the global conditions to change the downward trajectory. In fact, even the finance minister Hunt acknowledged that it was a tough road ahead and was likely to get worse before it gets better. Obviously, the focus turns to US CPI, and the lead up to this number is quite mixed. PPI released on a month-on-month basis, causing some concerns. But a New York Fed survey yesterday showed that US household expectations for inflation in the year ahead fell last month to its lowest level since August 21. On the other hand, last month's JB's jobs report had shown that wage inflation had almost doubled on a month-on-month basis. After October 7.7% year-on-year increase, which was lower than 8 expectation, November's consensus of 7.3 could be hard to beat. I mean to say, the expectations may at best be met. Leave investors a bit disappointed if it comes, even matches the expectation, because some whisper numbers are at 7 or even lower. Though it would still be the 5th month in a row of lower year-on-year reading, it's still at a very high level. A 7% plus is still high, and thus the meeting expected from Fed in the, on Wednesday, unlikely to change the stance and look to keep rates higher for longer, possibly poised to raise the terminal rate slightly above 5%. Traders were seen in different worlds overnight in US as stocks rallied strongly, but bonds fell hard. I was wondering whether bond traders were missing something that equity guys knew, or was it the other way? Perhaps it was down to positioning or poor response to new paper issuances by the Treasury. Yeah, I always look for some fundamental explanation for a rise or fall in any market, but yesterday I could find one simplest explanation that there were more sellers in bonds than buyers. There were more buyers in stocks than sellers. So that was it. Oil prices, after a multi-week decline, jumped as a crude pipeline supplying the US closed, and Russia threatened to, introduce a production cut, even as China's loosening COVID-19 restrictions bolstered the demand. Looks like 75 on the Brent is offering very good support. Dollar index has found good support at 104, despite market expectation for a weak inflation number, and possibly Fed confirming a slow approach to further actions. Euro has found it difficult to break 106 on several attempts. So has sterling at 123. Dollar yen rallied strongly above 137.60, reaching reacting to inch up in the yields. All this tells me that market is already well positioned on the short side of the dollar for any dovish news from CPI or the Fed, and scope for reversal is far higher, even with expectations being met. But if the numbers do come higher, a swift rally in the dollar index to 107 or 108 cannot be ruled out, pushing euro towards 102, GBP below 120, and yen above 120. So just end this update with a wish that the dovish dreams of players are not shattered. Otherwise, we will see a very painful pullback in the dollar to the higher side, or stocks and bonds to take a big hit. Thank you.
Okay, JK, that was quite interesting. And yes, I mean, in financial markets, humans being backward looking more in terms of reasoning, we try to identify what sort of reasons can be associated, but it's much better when we have a simpler explanation to all these things. Coming back, yes, on the UK front, there's a downward trajectory that can be observed, which can get worse before it gets better, as per Jeremy Hunt. On the domestic side, the uninspiring IIP and the manufacturing sector has kept some sort of excitement on the lower side, even though the CPI number was quite good. And for the US folks, we are expecting the release of inflation data in the US today, which can, even though be on the softer side, continue to still be on the higher range of inflation data, which can still continue to put the US on some concerning side. And even though the market is positioned well to go for dollar strength, any surprise will make the markets move in the other direction. So that's that for the today's updates, folks. We can come back again tomorrow with another round of updates. Thank you so much for listening.